morning, good afternoon, and good day. I'm Marcia Collins-Morose, your chair for CGBN, and my co-chair, Getty Greer, is here with me, along with our president of NICAR, Dimitri, Lachman. I may have just butchered your last name. My apologies if I have done so. And of course, Teresa Mueller's with us. She'll be conducting the Wants and Needs program directly after this. Before we get started, I do have an obligation to read the following disclosure. Many of the persons listening or watching this webinar may be direct competitors in the real estate brokerage business. Therefore, to avoid any liability under the federal or state antitrust laws, any discussion of competitive business practices and or amounts of fees and or commissions charged or to be charged by real estate brokerage companies to their customers or clients and their, wow, this is long, and or compensation and or splits paid or to be paid by brokerage companies to other brokerage companies is strictly prohibited. NICAR's policy is that it will not entertain any discussion that creates the potential of a violation of the federal or state antitrust laws at any meeting, podcast, or conference sanctioned or sponsored by NICAR. Well, thank you for listening to that. Now, I'd like to take a moment to give you a little background of our guest speaker today. She's amazing. She's also in the process of learning flamenco. I can attest to that. We were dancing together in Sarasota, and that's how I had the pleasure of meeting Nena Mills. She has been in the industry now for since 2012 and currently serves as the National Education Director for FIRPTA Solutions. She specializes in all things FIRPTA related, which she has affectionately earned the title of FIRPTA Queen. Nena is an IRS designated certifying acceptance agent and a registered tax return preparer. She has spent the last 13 years sharing her FIRPTA knowledge with countless realtors and title companies through classes, speaking engagements, expos, and other networking events. Nena received her Master's of Business Administration degree with a concentration in International Business in 2013 from Weber International University after simultaneously earning Bachelor of Science, wow, you're a busy lady, in Business Administration degrees, one with a concentration in marketing and the other with a concentration in accounting. Nena is a native Floridian, and when not working with foreign sellers and buyers, she loves to read, play banco, watch Law and Order, bing, bing, and spend time with her husband, Troy, and their children. FIRPTA Solutions, the company that she currently works with, has been sharing their expert knowledge about FIRPTA to the real estate industry since 2015. And helping clients is their passion. Their team of experts have over 30 years of combined knowledge, making FIRPTA Solutions the natural go-to for FIRPTA advice. FIRPTA Solutions focuses solely on FIRPTA-related issues to assist clients with tax compliance concerning all aspects of foreign tax withholding in all 50 states. In addition to FIRPTA form preparation and advice, FIRPTA Solution offers ITIN certifications by their certified acceptance agents, which of course we'd mentioned Nena is one of those such agents, U.S. and tax income preparation, and access to multilingual staff. They provide educational webinars and in-person classes, and in some cases can offer CE to title agents and realtors in certain select states. So Nena's going to go over what FIRPTA is, who it applies to, when does FIRPTA apply, FIRPTA and 1031 exchanges, FIRPTA and LLCs, very important to understand that. I'm appreciating that she's going to give a lot of concentration to that in particular. Buyers' responsibilities and affidavits, and the FIRPTA process, the importance of ITINs in the FIRPTA process. So without further ado, let's go ahead and turn this over to Nena so she can give us her presentation. Nena?
So thank you so much, Marcia. One, for letting me tread on your toes when we were learning flamenco, because I am a terrible dancer as a whole. But also for inviting me to speak to everyone today. Just as you said, honestly, I hate to hear my bio read because I always feel like it sounds way more impressive than it actually is, right? It's kind of embarrassing. But I wanted to reassure everyone that when I started in the industry back in 2012, I didn't even know what FIRPTA was. So if it's not something that you're very well versed in, don't worry about it. I'm going to give you enough information today to be dangerous. And more importantly, what I want you to take away from today is the fact that you do have a resource in myself and my company for any questions, moving forward. I'm always happy to answer, provide advice. And not only does FIRPTA Solutions to handle FIRPTA things, we're also backed by a full service CPA firm. So if you have something beyond FIRPTA that relates to U.S. tax, please feel free to reach out regarding that as well. So I'm going to hopefully share successfully. We did a practice run on this, and it liked me at least once. So hopefully it likes me again. And I think, there we go. Perfect. Oops, don't want that in there. It almost likes me perfectly. There, how about that? Okay, so we're just going to jump right into this. Like I said, we're going to talk about the basics of FIRPTA, and I'm going to kind of emphasize where this comes into play, or things you need to know from a commercial standpoint as well. So, the first thing that I always ask is, what exactly is FIRPTA? And FIRPTA is the Internal Revenue Services regulation that allows the U.S. to tax foreign sellers on their disposition of U.S. real property interests. So what that really boils down to is that this is the regulation that allows Uncle Sam to get their piece of the pie from everyone. Government's universal. They'll take money from anybody. And this is their way to make sure that they're getting this even from our foreign sellers when they are selling here, because there is certain taxes and things that come into play. Specifically, capital gains tax is the thing we see the most in connection to FIRPTA. And that's just simply because anytime a foreign national sells a U.S. real property interest, it's considered an investment sale. Any investment sale is always going to be subject to capital gains. And so that's kind of the reason that FIRPTA was instituted. Now, FIRPTA came into play in 1980. And the reason that this was created was actually incredibly logical, a very logical move on the IRS. I always joke in my classes that this was probably the first and last time the IRS was logical, but they had to get it right at least once. And I really do think that happened in this case, because as I mentioned before, anytime a non-resident sells a U.S. property, it's considered an investment sale. And that's primarily because a non-resident cannot have a primary property in a country of which they're not a resident, which again means that capital gains is going to come into play. Now, the big difference is that if you or I sell an investment property, the IRS knows exactly where we're at, right? They can garnish our wages, they can take our Social Security, they can put a lien on our house, our other houses, whatever it may be. They can knock on our front door. But when it comes to foreign nationals, they don't have that same set of recourse. So the IRS created FIRPTA because they determined that it made more sense to withhold money and keep it here in the United States, forcing the seller's hands to do something to kind of take action to settle with the IRS and only pay what they actually owed and get that difference back. They felt that it was easier to hold that back at closing than it would be to try to go to, say, Madagascar next year and get someone to file a tax return and settle with the US. So from that perspective, from just convenience alone, this made a ton of sense. And so the IRS created this back in 1980, and it has been in place ever since then. Now, when exactly does FIRPTA apply? So FIRPTA is going to apply anytime a foreign national or a foreign entity sells a U.S. real property interest. So because of that, the sale price, the use of the property, gain, loss on the sale, none of those things determine if FIRPTA applies to the sale. The driving force behind applying FIRPTA is simply the status of the seller. So you'll hear a lot of crazy things out there. You'll get a lot of different concepts, a lot of different ideas. Does FIRPTA apply in this? Does FIRPTA apply in that? But the jumping off point is simply, what is the status of the seller? Because of this, we can almost argue that every sale is subject to FIRPTA until we prove that it isn't. But just keep in mind, again, that sale price, use of the property, whether there's a gain or loss on it. None of those things actually determine if FIRPTA applies or not. Simply the status of the seller is the driving force. Now, that leads us to who exactly is subject to FIRPTA. So foreign sellers can be individuals. They can be foreign-owned corporations, they can be LLCs, and they can be trusts. So I'm going to take a few minutes right here because this is where I really want to focus from a commercial perspective. So foreign sellers as individuals, that's pretty obvious, right? If Mr. and Mrs. Brown are from, Madagascar, like I said before, probably pretty easy to determine if they are in fact subject to FIRPTA or not. We can check their passport. We can just flat out ask them. A couple things we can do, but that's going to be a fairly easy thing to determine. Foreign-owned corporations. So foreign-owned corporations are exactly what they sound like. They're corporations that were not formed here in the United States. So that means that if a company comes in and it's not formed in the United States and they buy a property here in the U.S., when they get ready to sell that property, their sale will be subject to FIRPTA. Now, there's a couple things we have to look at with this. Foreign-owned corporations can elect to be treated as U.S. corporations and operate under U.S. tax laws. If they do that, they're going to tell you, so you're going to know for sure when they're selling, and that changes whether FIRPTA applies or not. But short of that, if it's been formed outside of the U.S. and they sell a U.S. real property interest, then FIRPTA is going to apply. And yes, that does include Canada. They are not the 51st state yet, probably never will be. I know we have a lot of business dealings with them, but they are still considered foreign, much like the Bahamas, getting close to Florida. I know that Floridians think that the Bahamas are their personal beachfront, but the Bahamas is still its own country. So if a Bahamian company is selling, it's going to be subject to FIRPTA. Now, there are some places that can be a little bit different. So in my neck of the woods, we see a lot of influence from Puerto Rico. Puerto Rican individuals are not subject to FIRPTA because they are considered U.S. residents for tax purposes, but companies that are formed in Puerto Rico that have not elected to be treated as U.S. companies are in fact considered foreign and subject to FIRPTA. So there's a lot of little anomalies when it comes to corporations, foreign-owned, and territories and things of that nature. But if you have any questions, we can always research that and let you know for sure if FIRPTA will apply. Now, let's talk about trusts really quick. So I mentioned before that trusts are probably the bane of my existence, to be honest. And not that I don't think that trusts are great things, because I absolutely do. I think they're actually super clutch when it comes to estate planning and things like that for foreign nationals. But determining if FIRPTA applies to a trust is a little bit more tricky than it is to some other things. And that's just simply because we have to determine where the trust was formed, what country actually governs it, who the actual owner of the trust is, and we have to determine their status. So typically when it comes to trusts, I will ask for a copy of the trust agreement so that we can determine exactly whether FIRPTA applies or not. But a really quick rule of thumb is going to be that if it's revocable, we're going to look at the beneficiaries and what their status is. If their status is non-resident, then FIRPTA is going to apply to the sale. And there's going to be irrevocable. And with irrevocable ones, we have to look a little bit deeper because, again, those tend to be treated like their own entities. So we absolutely need to know exactly where they're formed, what country actually governs them, so that we can make a determination as to whether FIRPTA will apply or not. If you have a trust that is selling a property and you're not sure if FIRPTA will apply, feel free to send me the trust document over. I'll review it. I'll actually get a second pair of eyes on it, because I always think when it comes to trust that two sets of eyes are better than one. And I'll come back and let you know for sure if FIRPTA is going to apply. Now, foreign sellers can also be LLCs. And LLCs, to me, are probably the trickiest thing to determine if FIRPTA is going to apply. So basically what happens is foreign sellers can come in and they can form LLCs in three different forms. They can form a single member LLC. We sometimes call that a disregarded entity, maybe a sole proprietorship, single member LLC. Those are all relatively interchangeable terms. They can form a partnership, or they can form a C Corp. The way the LLC is formed will definitively impact whether FIRPTA will apply to their sale or not. So the way this works is that if they form a single member LLC, sole proprietorship disregarded entity, what they're really doing in this case is putting a little bit of protection on their property. So my favorite analogy is it's kind of like putting a sweater on. We put a sweater on and we give ourselves a little bit of protection. We haven't really changed anything materially. We've just given a little extra layer of protection to ourselves, right? A single member LLC works the same way. It hasn't changed anything materially, meaning that all income and expenses will still run through the individual or entity that owns the LLC. It just means they put some liability protection on that LLCs to help protect their investment. So what happens in that case is that when they get ready to sell, the IRS will say, hey, take off your sweater. Let me see your status t-shirt. And if your status t-shirt says, hi, I'm a non-U.S. resident, then FIRPTA is going to apply to that transaction. Now, partnerships and C Corps are a little bit different because when you have a partnership and a C Corp, it's kind of like you're building a closet to hang not only your sweater in, but also your status t-shirts. Because ultimately, the IRS doesn't care what's on your status t-shirt when it's a partnership or a C Corp. All they really care about in that case is where was the closet built. And as long as that closet was built in the U.S., then it's a U.S. closet or a U.S. partnership or a U.S. C Corp, meaning that FIRPTA will not apply when they get ready to sell. Now, what I do want to caution on this particular front, because we see this a lot, is that if you have foreign investors that are looking to purchase property in the U.S. and looking to form an entity, I highly, 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 highly recommend that they meet with an accountant, such as FIRPTA Solutions, that can advise them on the best way to meet their investment goals and to protect their investments. We don't want clients just randomly forming partnerships and C Corps because they can avoid FIRPTA, because at the end of the day, all of those things are going to do is prevent a withholding happening at closing. It's not going to change whether they have a gain or not. It's not going to change whether they owe tax here in the U.S. It's simply going to just change whether they have a withholding at closing. In some cases, depending on how they form it, it can even cause double taxation, for instance, for the corporation, because the corporation would potentially have tax on the sale, and then when they hand the dividends out to the members, they're going to have to also claim it as well. So it's very important that these investors are meeting with an accountant to get proper structuring and advice. Now, what I do see sometimes is I see realtors advising their clients 100% to form an LLC of some sort. And again, while I do think that's definitely viable, especially in commercial properties, they need to make sure they're choosing the correct entity. So, for example, our Canadian clients, we would never put them in a sole proprietorship. And that's just simply because the way Canada views that versus the way the U.S. views that is not tax advantageous for our clients. So when you have foreign nationals looking to form an entity and invest here in the U.S., they're looking at things a little bit differently. They're not just worried about how things are going to affect them in the U.S., they have to be concerned about how it's going to affect them in their home country as well, because the U.S. is not where they file their worldwide income. They're going to be filing their worldwide income in the country that they're from. So we have to look at things like tax treaties. We have to look at the way each country views the type of tax that they're going to be subject to and paying here and getting credit for, because some tax treaties between countries are very, very strong. Our tax treaties between countries like Canada and the UK, for example, give Canadian and British investors pretty much the same rights that U.S. Taxpayers have when it comes to tax breaks and things like that. But there are other countries that don't have as strong a tax treaty that may be relying simply on foreign tax credits, which can be as little as $50. So we need to just be 100% sure that when they're forming these LLCs, that they're doing so for the right reasons. And we need to make sure they're forming enough of them. And what I mean by that is that if you're buying multiple properties, there is a chance that you will need multiple LLCs, depending on the value, depending on, what you're doing with them, where they're located. All these different things can come into play. So when you have your foreign clients that are looking to invest here, specifically in either residential or commercial properties, if they're wanting to form an entity to do so, again, I cannot stress enough how important it is to work with an accountant to make sure that they're meeting the goals that they're trying to meet and still protecting their investments. Now, resident alien. So this is a pretty hot topic right now, as you guys know. But resident aliens are foreigners that are not really U.S. citizens, and they're not actually U.S. residents, but they are residents for the purpose of taxation. Because of that distinction, if a resident alien is selling U.S. property, they are not subject to FIRPTA. But there are two tests that we perform for resident aliens to determine that this status is valid, and each seller must be evaluated individually, which is the case for all FIRPTA-related things. The IRS does not view foreign nationals as one unit. So if it's a husband and wife, they still have to be evaluated individually to make sure that they're all exempt for FIRPTA or all subject to FIRPTA. So the two tests with resident aliens are the green card test, which is exactly what it sounds like. Do they have a green card? If they do, is it current? And do they have it in their possession? If they do and can provide that to title, then they can actually sign something called a certificate of non-foreign status, and FIRPTA will not actually be applicable to their sale. Now, the second test that we have available is the substantial presence test. And this is a little bit more mathy math. So if you guys are not into math, this is probably not going to be your favorite test to utilize, but it relies strictly on physical presence in the United States. And the way this test works is that if the seller is in the country for 31 days during the current year, and we add the number of days that they were here the year before and the year before that, using a calculation of all of the days in this year, a third of the days last year, and a sixth of the days from the year before. If once we get done with all those fractions, if that comes up to 183 days or more in the U.S., then they can be considered U.S. residents for taxation, and they can be exempt from FIRPTA withholding. Now, something they need to consider is that not all non-residents can use substantial presence based on their visa type. Probably the most notable one, I should say, is the student visa. Student visas, which are your F1s, F2s, they are required to be here for at least 5 years before we can start counting their days towards substantial presence. There are a ton of visas that are like that or have some kind of caveats. G4s or diplomatic visas, they do not, their days are not counted at any time, even though they work and live in the U.S. They typically aren't paying U.S. taxes, therefore they're not exempt from FIRPTA. There's a lot of different things that go into determining if substantial presence can be used or not. Something also to keep in mind is that actual immigration status and tax status are two different things. So when I'm meeting with your clients, when I'm asking questions, I'm not trying to determine whether they're here legally or not. To be honest, it doesn't really matter to me. What I am trying to determine is whether they are going to be treated as a U.S. tax person or not a U.S. tax person. And that's the sole interest in this. And that's what the SPT test designs. Now, because there are so many pieces involved in this, what we have seen now is the trend from title companies is that they are now requiring certified letters from CPAs that have actually checked this and determined that the SPT is valid and applicable to their client. That is a service that we will provide. So if your client is in that situation, we can definitely go through all of their documents and do an official inquiry to make sure that we can advise title whether they meet this or not, so they can be exempt from FIRPTA as well. Now, FIRPTA and 1031 exchanges. So 1031 exchanges are a brilliant mechanism to kick capital gains down the road, right? 1031 exchange allows our clients to sell property 1, take 100% of the proceeds and invest that in property 2, and at the same time, kick their liability down the road until they sell property 2, or continue rolling in 1031s until they're not here to check in anymore and they leave it for their kids to clean up. But it's a brilliant mechanism for capital gains deferral. It is available for non-residents as well as U.S. residents. And a lot of people don't realize that. They think that it's strictly for U.S. residents, but that isn't the case. The key, of course, is that the properties must be investment properties, and they must be reinvesting 100% of the proceeds from the first sale into the second one in order to get the full benefit of the 1031 exchange. Now, the 1031 exchange, a lot of foreign nationals think that if they do the 1031 exchange, that they will be exempt from FIRPTA. But that is not the case. The IRS does not allow FIRPTA exemptions just because you're doing a 1031 exchange. So that does create a little bit more difficulties for our clients that are investing using a 1031 exchange, simply because they don't have 100% of the proceeds available at closing. They only have 85% for easy math. So what that means is they have to figure out a way to get that 15% dumped into the 85% bucket so that they can reinvest that money with the 1031 exchange. Pre-COVID, that was fairly simple for us to do. It is not as simple anymore, and a lot of times now we cannot meet the 180-day deadline that the 1031 exchange requires. So what our foreign nationals must do is they must be prepared to bring the equivalent of that 15% withholding from some other source to dump in that bucket with their 85% proceeds for reinvestment to get the full benefit of the 1031 exchange, and then wait for the IRS to release their original 15% so they can effectively reimburse themselves. Now, there are some 1031 exchange companies that will allow a simultaneous 1031 exchange, meaning that they sell property 1 and buy property 2 all on the same day. If you can manage to pull that off through the same title company, meaning that there's never any hint of money being sent to the sellers, then FIRPTA may potentially be avoided on that sale. But it's super complicated to set both of those up. You know how hard it is to get one closing set up. Can you imagine trying to get 2 for 2 different processes? And if anything goes wrong in either one of those sales and one of them has to be bumped back, it's going to change it and put back in the 15%. So I highly always recommend that they have the 15% ready to bring just in case. Even if they're trying to do the simultaneous 1031 exchange, they need to have that 15% somewhere as a backup in case something goes wrong with that and they actually have to put that together to make that 1031 exchange happen. Now, there are no exemptions to FIRPTA is what I get asked about the most, probably on a daily basis, if I'm honest. But there are no automatic exemptions for FIRPTA unless you want to consider being a U.S. entity or U.S. resident as an automatic exemption. So short of that, what there are affidavits that the buyers can choose to sign that can alter the way title is required to handle FIRPTA withholding. The caveats there are that only individual buyers are allowed to sign these affidavits. And even if the buyer is an LLC purchasing a property for the owner of the LLC's primary residence, or even a trust, they are not allowed to sign these affidavits. They must be actual individuals and have no hint of an entity of any sort associated with buying to be able to sign these affidavits. Now, the first affidavit has been in place since 1980. And this affidavit is for properties that sell for less than $300,000, and the buyer intends to reside in the property for more than 50% of the occupied time over the next 2 years. If these conditions are met and the buyer is in agreement to sign the affidavit, keywords in agreement, then title is no longer required to withhold FIRPTA at closing. Something to keep in mind, though, is that even if the buyers meet the requirement, they are not required to sign this affidavit. It is simply there and available. This is not my favorite affidavit because I feel that it leaves the buyer exposed a little bit, just maybe a little tiny bit, but that's a little bit more than I want anybody to be exposed, so it's not my favorite. Luckily, I feel like the economy, the industry have priced this affidavit almost out of existence. At least where I'm located, there are very few things that are less than $300,000. And the things that are being snapped up by investors to use for rental properties, so they don't qualify for this affidavit anyway, but it is out there if it's something that you want to use. Now, the second affidavit came into play in 2016, I believe it was. And this affidavit I actually really love. And shockingly, I don't see realtors use this very much. And this always surprises me because this affidavit applies to sales that are more than 300, but less than a million, which is pretty much all of the residential market, unless you're doing luxury sales. If it falls in that price point and the buyer intends to live in the property for more than 50% of the next 50% of the occupied time for the next 2 years, if they choose to sign this affidavit, then title is no longer required to hold 15% of the gross sale price at closing. Instead, they only have to hold 10. This is a huge thing for sellers. Even with a house as small as, say, $500,000, right? If this affidavit is signed, we're holding $50,000. If it's not, title is holding $75,000. So $25,000 is quite a bit of money, especially for non-residents that may be looking to reinvest or to repatriate their money back to their home country. That's quite a bit of money to leave sitting on the table simply because someone forgot to try to utilize this affidavit. I love this affidavit because it protects the buyer and still gives the seller some kind of relief. So I am 110% in favor of this one, but either affidavit is available there for use. And if it's something that you need, you can always reach out to me and I can always provide that to you so that you can present that to the buyer when you're on the listing side. So what exactly is the current FIRPTA process? So the IRS has two options for the way FIRPTA is handled. The first option is basically pretty simple, and the way it works is that the full FIRPTA withholding is just submitted to the IRS within 20 calendar days of the date of closing. The title company cuts their check or their wire, whatever they're going to do, and they send this money to the IRS, and they send it there with these 8288 and 8288 forms. The IRS will process those forms. They will allocate the funds to the buyer and seller via a credit debit method. And then once those funds are allocated, the IRS will issue a receipt of funds in the form of something called a stamped copy B. That takes about 4 to 6 weeks. Okay. So the FIRPTA funds stay with the IRS until the tax return for the year in which they sell is filed. Returns can only be filed once the stamped receipt is received and tax season opens. So what I mean by that is that if your client sells today and they are subject to FIRPTA, this is 100% the applicate or the route that I am going to recommend they take. We are literally 15 days from the end of the year, which is crazy in itself that I just said that. But we're so close to the end of the year. From a timing perspective, this makes the most sense. Now, what will happen though is that assuming that everything is where it needs to be, closing happens today, money's going to go to the IRS. The IRS is going to have to issue a receipt to us that's probably not going to get here till the middle of February, to be fair, because we've got holidays coming in. So once that receipt comes in, conveniently, tax season opens for non-residents roughly the middle of February as well. So we should be able to go ahead and file their tax return pretty close to the opening of tax season because we should have that receipt back. Once that the tax return has been filed, it will be probably 8 to 12 weeks before their refund is issued. So if they sell today and everything lines up properly, they're probably looking at about June to get their refund. That's not too bad, right? That's pretty reasonable. Now, if your client sells on January 2nd, right, which is only, 17 days away, then if we do this option, this is a 2026 transaction now. That means that all the things I just talked about are going to happen during 2026, except the tax return will not be filed till 2027. So that means with this particular option, they will not get any part of their refund back until probably roughly May of 2027 once we go into 2026. So there's definitely a reason why we're pushing. If you have a sale right now that's closing the first week of January, we're probably going to be pushing to try to move it to 12/31 to try to get it in on 2025 if you've got a foreign seller for just this reason. But that's the way it works once it goes into 2026. It's a 2026 transaction, which means refunds under this particular option don't get issued till 2027. Now, Withholding certificates are their other option. This is not something we've traditionally done in the last 2 years. Most accountants stopped applying for withholding certificates roughly mid 2023. And that's simply because the IRS had gotten to the point where they were taking approximately 2 years to even process these. A 2-year turnaround time on this is still longer than the 18 months from the first option, right? So if your client sold January 2nd, they're still going to get their money in roughly June 2027 under the first option. But the way the IRS was processing option 2, if they sold today and decided to do the withholding certificate, it would be more like sometime in 2028 before they would get their money back. So because of that, we're not recommending this option. Now, the IRS has actually finally caught up with this things from COVID. We are going to be promoting this starting in January, and it is an amazing option for our clients because what it does is it allows their money to not be sent to the IRS, at least not initially. Instead, we prepare an application. We send that application to the IRS. We say, hey, can you look at this? If we can prove they're selling for a loss, the IRS will actually come back and tell us, don't send anything to us because they're selling for a loss, which means that your client's money can then be released at that point. Or if they're selling for a gain, the IRS is going to ask for a portion of that withholding to be sent to them, and the balance can be released to your client. The best part about it is our best guesstimate right now is the IRS is only taking 4 to 6 months to make this happen. So if a client sells in January, I'm probably going to recommend that they go this route, because roughly by June of 2026, I should have some kind of answer for them. If they sold for a loss, I should be able to return all of their money to them. If they're selling for a gain, I should still be able to return probably at least half of their money to them. And the balance will go to the IRS, which of course they'll have to wait till 2027 to get. But I don't know about you, but I'd rather have half my money sitting at the IRS than all of my money sitting at the IRS. So it's still a super viable option. Like I said, it is something coming back. We will be offering that in January again, or closing starting in January, so that clients can have a little bit of relief and not have to wait a full 18 months to get something. Now, U.S. tax numbers are the last part of this. They are absolutely critical to the success of FIRPTA. Foreign nationals are given, individuals anyway, are given something called an ITIN. That's an individual taxpayer identification number. And in order to obtain any part of the refund of their withholding back, they have to have a valid U.S. tax number. And that tax number has to correspond to the way they own the property. So where this becomes key here in your situation is that our foreign nationals love to come over and buy property. We love to let them. They love to form companies, and that's cool too. They love to get EINs for their companies, also super awesome. But what they don't love to do is then actually purchase the property in their company, which is mind-blowing, right? They've taken all the steps to have it there, and then they don't take that final executed step to make everything happen. And when they get ready to sell, they come and they see me, and they're so proud because they have their company, they have their EIN, and then I have to be the bearer of bad news and tell them that I'm sorry, but this is not going to work because you own this personally. So I get to be officially dream killer for them for the moment, which also, side note, is what my children call me when they want to do something stupid and I tell them no. So just keeping the dream alive, But we have to tell them that we have to do something different, right? Because at the point it comes to me, if they make any changes at that point, it could be looked at as tax evasion. So we don't want that to happen either. So then we have to get them a tax number, and we can absolutely do that. Also key to remember that some of our foreign nationals will have social security numbers. That does not necessarily negate the need for FIRPTA, because they could have gotten that social security number in the mid-90s before ITINs were issued. They could have had it because they came here to college and had a job on campus. They may have had a green card at one time that they've revoked. There can be all kinds of reasons why they have one, but that does not automatically give them resident status. So assuming, but the only thing it does do for them is that if they have a social security number classified as a non-resident, when they get ready to sell, we do not have to get them any other tax number. They can use that unless, of course, they own it in a business and we have to get them an EIN or something like that. But if from a personal perspective, if they have a social security number, they would not need an ITIN. But But assuming that your client has neither and they need one, we kind of have to jump out of our box for this because we're very much in an e-sign world. Clients sign contracts, e-signature. We complete closings with e-signature, right? We've got RON, we've got all these different things. But when it comes to getting a U.S. tax number for our individual foreign nationals, they have to have the ability, at least currently, to be able to print the W-7 that I'm going to send them, find their pen, and actually sign it with their little, hot little hand. And then they have to send that signed W-7 to me along with supporting documents to allow me to apply for their I-10. Now, the catch here is that the documents must be originals or certified originals. And certified originals are actually things like the passport you would show at the airport, like the one you pull out of your purse, or your driver's license, again, the one you pull out of your wallet, or your birth certificate. These are all documents that we can use to obtain their ITIN. Now, they either have to actually send those to me wherever they may be in the world. They can come in my office if they happen to be here in Florida. They can meet with us and we can certify their passports and other documents for them while they're here because we are certifying acceptance agents. But if they are not here and they're not going to be here, then they have to either find a certifying acceptance agent in their own country, which I don't actually recommend them doing because once they do that, that person has control of their I-10 application. It's not something that we can actually look up and follow. Or they can go to the U.S. Embassy or they can get it certified by the agency that issued the original document. What they cannot do is get it notarized. And that is simply because notary standards are not the same globally. So here in the U.S., everybody on this call could pay $50, I think it is, take a test, and we can all be notaries. That's not the case everywhere. For instance, in the UK, being a notary is actually a career. So they're vastly different global standards. So as a result, the IRS does not allow for notarization. The certification, as I mentioned before, can be done at the U.S. Embassy or the agency that issued the original document. But believe it or not, most of our clients, if they're not physically here in Florida, choose to send us, their passport and their W-7 via DHL, FedEx, what have you, because it's just simpler. U.S. embassies are not always open. Sometimes they're difficult to make appointments at. Sometimes they're very far from where they live. And if they're trying to go to the agency that issued the original document, not all agencies certify their passports. And in the case of our South American clients, they're probably not going to want to go to the police station and ask for a certified passport because they're going to ask them why. And they're going to have to tell them to buy or sell a house in the U.S. Probably not high on their list of things to do. So as a result, they just put those in a DHL, FedEx, UPS envelope, whatever, and they send it to us and we return it to them. Now, it does take about 4 to 6 weeks to get an ITIN for somebody once we receive all the documentation. Good news is you don't need that for closing. So I don't want you guys to panic thinking that's going to hold your closing up because it won't. It's just something they're going to have in order to get their FIRPTA withholding done. Or if they're an investor purchasing a property, they will also need an ITIN if they're going to rent it. So these are all different things that we can do. The I-10 process is the same on either side of it, but it's incredibly important, again, that if they're selling, they get this done because their refunds, their withholding won't be released. If they're foreign nationals buying and they're going to be renting it or have other tax requirements here, it's important that they get that tax number as well so that they can be set up for when they do get ready to sell. So all that being said, always leads to the question of, can we just ignore FIRPTA? I'm going to just tell you, probably not a great idea. And funnily enough, with FIRPTA, we've talked all about the sellers, right? It's the seller's money. The sellers need the withholding number. The sellers file a tax return. But guess what? The buyer is the one that's actually responsible for making sure that FIRPTA happened. I told you guys the IRS was logical only once. Clearly, it was not for this, so they didn't get a second logic move. Although, from an IRS perspective, this is very logical to them because the penalties, the FIRPTA, the withholding, the capital gains, all of that is attached to the asset. And after closing, who has the asset? The buyer. Where is the asset? The U.S. So it does make a lot of sense from from that perspective, because that way we don't involve international law or guidelines or anything like that. It attaches to the asset here in the United States that unfortunately is now owned by the buyer. Now, the reason this is such a big deal is because buyers can be hit with three types of penalties. One is a failure to pay, a failure to file, or interest. If you want to have an idea of roughly how much this can equate to, take the FIRPTA withholding amount, multiply it by 5%, and that is approximately the penalty for 1 month. Now, these penalties, some of them can be continued in perpetuity until it's actually settled or paid for. So it can be a huge bill. I had a client not too long ago, literally 31 days late paying this, right? And it was some random error. 31 days late cost them $6,000. That's pretty stiff for 31 days, right? I mean, that's nothing in the big scheme of things. That's oh my gosh, I laid the bill out on the table and forgot to pick it up off the corner, right? But for 31 days penalty, they had $6,000. So FIRPTA is definitely a big deal. Good news is that you have somebody in your corner, and that is us. FIRPTA Solutions, as I mentioned before, we are a full-time FIRPTA company. We are here to answer any questions that you have. Even if your clients ultimately decide not to work with us, we still want to make sure that they are getting the right and proper knowledge to facilitate their transactions here in the U.S. We are always happy to answer any of your questions. And as I told you in the beginning of the presentation, my goal today was just to kind of give you a rundown, kind of give you a little bit of extra knowledge to be dangerous, but ultimately this is the screen I want you to take away so that you can reach out if you have any questions in the future. I'll also drop my personal information in the chat in just a few minutes. I did put this particular email on the screen because I do travel. I don't want you guys to be waiting for me to set up my computer somewhere, because sometimes that doesn't happen like it should, because I want you to get your answers when you can. But if that's it, now all we're waiting for is any questions that you might have.
So this was wonderful. Such good information. I can't hear it enough, quite frankly, and I'm so glad that we do record these sessions. Nena, I do have one question for you, and I know we've got Dr. Mustafa will be the next to ask a question. So when you're a dual citizen, and because it does drill down to you. It does eventually drill down to you as a person, right? In a sole proprietor situation. Is it the substantial presence test that distinguishes whether or not you're going to be subject to FIRPTA then? Is that how it would work?
So when you're a dual citizen, so the U.S. is kind of complex from that perspective because we don't really recognize dual citizenship. So you're either a U.S. person or you're not. If you're a dual citizen, obviously U.S. is going to be one of them in this case. You're going to use your U.S. citizenship to be exempt from FIRPTA, but keep in mind that as long as you are classified as a U.S. citizen, you are required to file your worldwide income here. So whether that benefits you or not, that's your actual requirement. And there may be other things you have to file if you're earning income outside of the U.S. and things like that. But generally speaking, if you have U.S. citizenship, you can be exempt from FIRPTA.
Well, and what I'm taking away from this, especially today, is that it makes good sense to reach out to you first, have a consultation call with our client. So, definitely make you part of our international team. Absolutely. So I really appreciate this. And I know we only have just a scarce few minutes for questions. So Dr. Mustafa, if you'd like to ask yours, and then after Teresa, I don't know if there's anybody, but Dr. Mustafa, please unmute and ask your question.
Okay, my question is, some of the dates that is mentioned that you mentioned for even going like the 45 days, the 180 days for the 1031 exchange as an intermediate, have you found that those dates are still absolute? And also for doing the LLCs in Illinois, there's about 3 or 4 different ways of you can manage your LLC. Do you provide legal advice for those people to do in their LLCs? Thank you.
So thank you for your question. In terms of the 1031 exchange, as far as I know, those dates are still being utilized, the requirements of selecting the properties and identifying the properties and things like that, you would want to talk specifically to a qualified intermediary at a 1031 exchange to confirm that. We unfortunately are not allowed to be QIs because we're typically too close to the transaction. So our part would really be more to report it from a tax perspective. In terms of the Illinois LLCs, so we are not an attorney firm, so we do not provide legal advice on anything. What we would do is we would actually advise your client on the tax ramifications of their choices and help them decide which method of LLC formation makes the most sense for them from a tax perspective. Now, that being said, we do work with attorneys to help give, legal guidance on that side. It's just not something that we would provide personally. We would only give them the tax side of things.
Thank you. And Teresa, you have a question after Teresa, Ahmed?
Thank you. That was like super informative, and my head was spinning because you had a lot of information there, way more than I would have expected. But I have two questions and then also a comment on the 1031s. And when you're saying, hey, they may have to hold back the 15%. Where does that go? Like, what land does that happen when there's that 15%? And then the other thing is, even though this is a federal program, is there any difference from state to state, or is it uniform across the board? And then the third was just a comment. We did have an international 1031 because a lot of times people say, well, can I go buy it somewhere else? There is something, a 1031 outside the U.S., but that means country to country. You just can't cross the border. So anyway, thank you very much. That was very informative.
Thank you. Okay, so for the first part, so basically what happens in the 1031 exchange for a foreign national is the title company is still going to hold the 15% for the FIRPTA withholding. Typically, we're going to proceed with FIRPTA on either one of the two options that I outlined. But what we're going to do in those cases is we're either going to ultimately end up filing a tax return if we use option one, proving that a 1031 exchange was engaged and utilized, which will allow the IRS to say, okay, here's 100% of your money back, right? Or if they qualify for the withholding certificate, we're going to do the same thing on that lines and never send that 15% in. Instead, we'll send the documentation to the IRS and say, okay, they've engaged in a 1031 exchange. Here's all the proof. They actually don't owe you any money. I need you to send me a statement allowing me to release that. And they will do so. The problem is they don't do it fast enough to meet the 180-day guideline, or at least we can't guarantee that they will, which is why I asked them to bring the 15% from some other source. If by some miracle the IRS gets that done before 6 months, then of course we can just use that money to release and put it in there. But it's kind of just hanging over here, either at the IRS or in an escrow account, depending on how we decide to handle it in the time of year.
Got it. Thank you.
Okay. And Ahmed?
Excellent program. It's a time of the year. A lot of people are hibernating and gone and doing other things. So it was last minute, but a great choice. And I hope we can do this at another time next year. So, at the end of the day, the seller is on the hook. How do you protect the seller? At what stage does somebody like you come in? Because, your service is to whom? The seller, the buyer? Are you taking charge of the entire process? Where do you come in?
So in Florida, the seller typically hires us. To me, that makes a lot of sense because it's the seller's money, right? They're the ones that are having to apply to get it back. The crux, of course, is that the buyer is the one's responsible. The buyer is the one that takes the heat if something goes wrong. Our standpoint is that while we are working for the seller, we're hired by the seller, we're also trying to protect the buyer by making sure that everything is done correctly. Your best bet to protect your buyer is to make sure that you are working with an accountant, or the seller's working with an accountant and a title company that understands how to work with international buyers and sellers. You don't want to choose a company that's only done one of these in 25 years. You want to find one that's accustomed to dealing with, so that they know what they're looking for, can give you referrals. You definitely want to use a company like mine that's experienced in this as well. And then have enough knowledge yourself to kind of ask some questions and look for things. You always want to ask, is the seller subject to FIRPTA? I think that's a universal question that should be asked on either side of the transaction, to be honest. And then if the answer is yes, do your diligence by double checking that title is in fact the holding. The accountant should be asking for some information. There's a few different ways to do that, but I think the best way, honestly, is just to have enough knowledge about the process itself to kind of have an eye on things when you're working with your international buyers and sellers.
So this makes a perfect sense, especially in Florida. One of the things we're cautioned about when we go through licensing is better make sure that you figure it out, because your buyer is going to be on the hook, and possibly you as well as the realtor. So very concerning. And we have so many international transactions in Florida. Nena, this was wonderful. We so appreciate you taking the time today. As I said, I'm so glad this is recorded, because there's just a plethora of information we can revisit. And the fact that we can reach out to you right from the get is huge. So again, thank you for your time. Go about and get that shopping finished, lady. We're going to go ahead and end this recording now. And Teresa's going to take it over now for the wants and needs section.